Ladies and gentlemen, it's a modern investing on Pod TV. My name is Sasha Star, and our guests today are Dr. Milan Sombarak. Welcome to the show, Milan.
Thank you for inviting me, Sasha. Delighted to be here.
Thank you, as always. And Jim Eat from Eat Foundation. Welcome to the show, Jim.
Thank you for inviting me too, Sasha.
So today is a great day for several reasons. First of all, announcement of NVDY dividends, 15 cents a share. It's not too shabby, it's not too great, but still money trickling in. That's
Okay, good.
nice feeling. Yeah, and today's NVIDIA's reports at 4 o'clock. And this will affect all market, including S&P 500 and Dow Jones and artificial intelligence stocks and quantum computing stocks, and just name it. Everybody is praying now for NVIDIA because there is no hide for this, because NVIDIA is a key stock of any ETF, any Dow Jones or 500, 492. No, 492, they can do whatever they want to do. Now, report is going to be magnificent. I can tell you that. However, interpretation of that report, that's something very different. This is, I'll tell you, I'm listening to some gurus and some specialists and professionals and not too professionals and so on. They are all going to pick up this report apart and to see, okay, this is great, this is great, this is great, this is very good, but data centers is not doing that well because there is a perception that there is no energy available for this data center. So therefore their chips, whatever they're selling today, they will be obsolete in 2-3 years. So why would then all those vendors like Meta and Microsoft and others, why would they buy these chips now? They will stop buying the chips. No more chips from NVIDIA. NVIDIA is going down to $5 a share. Okay, that's what we are going to listen to all specialists at 4 o'clock. So I'm ready for gyrations. That NVIDIA will go up to $200, down to $170, and in between there will be great fluctuations. Then Jensen will make his speech about. Normally his speeches are quite optimistic, so I'm not worried about this part. I'm worried about the specialists, especially those specialists who sold NVIDIA short. So I want to listen to their story, what they're going to pollute air with their predictions that there are some graphics that NVIDIA, it could go down to $164.55, and that will be the floor. Which if it will break this one, so then it will go down to $129.10. And if it will break that, it will go down to $96.11. And that's where there will be a grand support. It will not go lower than that. Why? It could go lower than that. If it will go down all the way to $98 or $90 or what else, $60 or so, it could go lower than that. Nobody said that it cannot go lower. But remember Nortel, it was $120 stock, it went down to $60, it went to $40. I had a friend of mine who said, okay, I'm going to take a mortgage and I'm going to buy as many shares at $40 because I said, why wouldn't you buy next day for $39? Why wouldn't you invest at 40? It cannot be. It cannot go. Why? To 39? It went down to 40. So why it could not go to $39? And I think I talked him into not taking the mortgage and buying at $40. Yeah. And a few weeks later, it was 12 cents or something like that. So, stories like that. I don't know how it could apply to NVIDIA. I don't think so. But something interesting, I have a great library of all kinds of investment books. Some of them were written 20, 30 years ago, And I have a habit of looking at some of the books from materials because remember the discipline of investments and psychology of investments, it doesn't change in 30 years. It's there forever because human nature is not changing. The fear and greed factors are still there. So one of the books that I have is this is a Disciplined Trader. It was written by one psychologist. It was published, by the way, by New York Library of the Discipline, the New York Institute of Finance. That's who published this book. And there is very interesting, what I want to read you, accumulating profits. I think this is something what we're all interested to learn. So here's what he says. Your ability to accumulate profits, either in a single trade or cumulatively with several trades over a period of time, is a function of your degree of self-valuation. How you like it? This sense of self-valuation is, in fact, the most important psychological component of success and will override all others in determining your results. So you want to do asset allocation, as Milan very familiar with, or you want to do day trading, or you want to do, just doesn't matter what. This is the most important thing, is a psychological component of success. So then he goes, your degree of self-valuation will regulate how much money you will give yourself. The market doesn't give you money, you give it to yourself based on your ability to perceive opportunity and execute a trade out of the maximum potential available or of perceivable at any given moment or time frame perspective, regardless of the depth of understanding you have of market behavior or what you consciously intend. You will only give yourself the amount of money that corresponds to your level of self-valuation. That's very interesting. The self-confidence when you build over the time by executing your trades, following certain sectors. Now, with experience, you learn about few interesting tricks. For example, let's say you want to sell covered call. Okay, so the covered call, so it fluctuates here and there. You put certain levels that you want to sell it at. Now, you are better off to sell at the market, and it means you will be filled. Okay, a cup of ticks here and there. You may lose as a result of it. Although spreads are now so thin, especially on the liquid stocks like Nvidia, it doesn't really matter. What does matter is that you want to sell at a certain price, and the calls are moving lower in price, so that you didn't fulfill your aim of selling the call. So now it's running away. You got a position which was not fulfilled, and instead of being there, and as it moves lower, so now you can execute a reverse trade and make some money. Instead, you're just sitting there and you don't know what to do next. So this is off the situation. And when you're buying stock, what's interesting, especially now when there is no commission, like Questrade, as you know, then you might as well buy at the market because you will be filled. So when the stock is moving higher, then you can buy another, say, 100 shares of NVIDIA, but you want to buy another 100 shares. Now you can put a certain price that you want to go on. Because if it's not filled, but you already have 100 shares, so you're already exposed, you're already making money. So the other 100 shares, you may get filled, you may not get filled, but it's not so important because you're already in. So this is a situation where if the stock is going down, then you might as well keep your position. But I wouldn't add to the position while the stock going down. I would just keep this. I would maybe sell covered call to be a little bit more secure. But generally speaking, you have to be very self-confident, regardless what you do, selling covered calls, it's selling puts, regardless.
There's a much better way when I get a chance to talk, I'll discuss a much better way to invest.
Much better.
Yeah. Can I talk about it now?
Yes, absolutely.
Well, I want to talk about artificial intelligence and investing. Now, the most common example of artificial intelligence for most of us is when we go to a store of any sort and they have a self-checkout counter. That's artificial intelligence in action. The self-checkout counter will replace at least 6 cashiers or more, which is a major expense. So now artificial intelligence can also be used to ask for advice, and it costs nothing compared to a human advisor, and it's much, much better than a human advisor. It's always correct. Now, for example, there are two sources. One is ChatGPT, and the other one is Google Gemini. ChatGPT is constantly pushing me to upgrade to a pricier version, whereas Google Gemini does not. People voluntarily upgrade with Google Gemini if they have multiple offices around the globe in order to use it. Voluntarily upgrade. So now, if you ask Chat or Google Gemini any kind of advice, like this morning, for instance, I asked, is today a good day to sell covered calls on SPY, just out of the market, at the beginning of the market, and expiring at the end of the day? And the answer, for a lot of reasons, complicated reasons, but the bottom line was, no, it is not a good day to be selling covered calls on SPY today. Now, that is advice that is constantly reliable, and so Google Gemini can replace specialists and human advisors, and it is always right. Human advisors are not always right. Now, human advisors are good for hand holding when the market drops. Outside of that, they don't match what Google Gemini does. So for people who haven't heard of it, let me spell it out. GEM as in Mike, N as in normal, I. Google Gemini. And Google Gemini downloaded and asked it all kinds of investment questions, like what should investors pay attention to today? And I asked today, is it a good time to be selling covered calls just out of the market, the beginning of the day, ending the same day? And the answer is no, it isn't, after a whole lot of explanations why it isn't. So I can recommend that to anybody. Anybody who doesn't have it should have it. You can ask Google Gemini any other questions, such as, for example, is sour cherry juice good for you? So it provides answers, and it doesn't cost anything unless you voluntarily upgrade because you have operations across the globe. So it doesn't cost anything, and it is 100% reliable, unlike a human advisor who does cost. So say goodbye to your advisor, say goodbye to specialists, and listen to Google Gemini. Now,
Did you follow the advice it gave you?
yeah, I did. Yeah, I always do. Yeah, it totally makes sense. Don't. Today was not a good day to sell covered calls on SPY at the beginning of the day, expiry date at the end of the day. Not a good day today. So I recommend that over human advisors and specialists because it is always right. Now,
Milan, have you seen the movement of SPY today?
it's dropped, I think. I'm not sure.
It's dropped. So it was a good idea then to sell covered calls, because if you would pocket all the premium, whatever you could generate.
Oh, well, you know what? Google Gemini also tells you what your chances of success are. For instance, yesterday or 2 days ago, I forgot. What's today's Wednesday? Yeah, a couple of days ago, I asked, and it said you have a 68% chance of success. 68% chance, not 70, not 65, but 68. 68% chance of success. So would you act on it? If you were a poker player and you had a 68% chance of winning with the hand that you have, you would bet on it, wouldn't you?
Yeah.
Depends.
Well, poker player, yeah. So So I listened to
But
Google.
Elon, based on your advice that you got from Gemini today, you lost because you didn't collect your covered calls premiums because of the Gemini. Is Gemini going to compensate you for that?
It's reliable. Today, you mean, Sasha, you mean that today, if I had sold cover calls at the beginning of the day, expiring at the end of the day, just
Yeah.
out of the money, I
Yeah,
would have made money? Is that what you're saying?
yeah, you would make money, right?
Well, in a declining market or a sideways market, yes, you would make money.
So today, if you didn't follow the advice of Gemini, but you did what you believe is the right thing to do, you would end up making money. Because of the Gemini, you were deprived of that opportunity and you didn't make money.
It sounds like you're right, Sasha. It sounds like you're right. However, I listen to Gemini because it is right so much of the time, which human advisors are not. Human advisors and specialists are not right all the time. So, and also they cost. Gemini doesn't cost anything unless you voluntarily upgrade. If you have a corporate operation around the globe with branches everywhere, in this case, you would voluntarily upgrade. So I can recommend it strongly to people who don't have. Now, I'm going to sound like a broken record here, but I'd like to say once again for people who haven't been here, haven't heard it, to listen to what David Svensson said.
Yes, yes, exactly.
Yeah, well,
What did you say?
he said you should have an asset allocation. Mine happens to be 50-50, which is 50% in US cash, not Canadian, Canada, US cash, and 50% in an exchange traded fund which tracks the S&P 500. And there's half a dozen of them. But SPY happens to be the best because it has the narrowest bid-ask spread. Many investors don't know what a bid-ask spread is, but it is a cost to investors. So SPY has the narrowest, it is the largest and the oldest, so the orders get executed all the time. So market orders are always executed. If you put in limit orders, yeah, might get executed, might not. So I always place market orders.
Milan, could you please tell us what is the return from the beginning of the year until today on SPY?
Well, we can look it up. I'm using a computer to meet with you, so I can't look it up. But the return on SPY, you can go to Google Gemini and simply ask, what is the return on SPY to date? And you'll get an answer.
I think I can get by without Google. I can just type SPY and then it will give you like anything.
Do you have another computer there, son?
S&P 500 is up quite a bit for the year to date.
Yeah, right. Yeah.
How much?
It's up quite a bit. It tells me over 700%.
700% SPY?
Yeah, something's wrong there with that calculation. But it started out the year around under 6,000, and right now it's at 66,000. So
No, something is
6,600. Sorry.
Is it overpriced, James?
That's a great question. And my feeling, you see, I look at the market a little differently. I look at it by sectors, and I'm invested in the AI sector. And so I don't have a broader interest in the S&P 500 because it's made up of a lot of stocks that aren't related to artificial intelligence. And I don't have any interest at this time in owning those stocks. So, you and I have a quite different focus. And I'm not criticizing yours because I think yours is a good blueprint for success over time. And
okay.
Yeah.
Let me tell you something that SPY from the beginning of the year up to today is up 12.97%. Okay, 13% from the beginning of the year.
Yes. And so I mentioned earlier that it's overpriced, probably up 13%. Generally over the last 200 years, the market has returned about 10% annually, not inflation, or yes, inflation adjusted. So if it's up 13%, it's above normal returns and it's bound to come back. There's no question about that. When it will come back, nobody knows. You know, you have momentum investing when people buy more as the market rises, which is the opposite of what David Svensson recommends, which is sell to take profits. And when the market drops and you have more cash than SPY, then you take that cash to buy at bargain prices to reestablish your 50-50 allocation. 60-40 is also good, and 45-55. Anything which you have.
For comparison, NVIDIA is year to day is up
Great.
37.74, it's almost 38%. So compare 13% and 38%. How do you feel about it?
In the long run, that's not sustainable. In the short run, yeah, you can make money in the short run. But, you know, as David Svensson says, using his method of asset allocation, the chances of outperforming what he recommends are close to zero.
I think at the time when Svensson wrote his literature, I think we're looking at 20, 30 years ago. I think NVIDIA didn't even exist at that time. But let me tell you something else. You're talking about short-term investment, and NVIDIA did better than S&P 500. Okay, let's take now a longer period of time. Let's say 5 years. 5 years is already something. NVIDIA in 5 years went up 1,276.25%. Now, for comparison, we will go back to our friend S&P, right? Okay. We'll do that. Okay, SPY in 5 years, it generated a profit of 85.03%. So how you can compare 85% to 1,200 something percent?
You know that 50 years ago or so, there was the equivalent of NVIDIA, that is, it was a major stock, and it would have been perhaps railroads. Railroads used to be 50, 60 years ago or more the equivalent of NVIDIA today, and railroads have collapsed. Also, oil used to be a favorite and the equivalent of NVIDIA today. Oil prices today are declining, and we will not be using oil in the near future when we're into renewables entirely.
Well, you know, the idea here that you're talking about, again, if you're taking a long-term perspective and you don't want to track the market and you don't have any interest in it, then I totally recommend your approach. However, if you are paying attention to the market in general and to specifics of what's going on in the world at large, then the AI sector didn't exist 20 years ago, is very modern, and is only growing at this point. And so the revenues are staggering what these companies are doing. And so when I look at them, they don't have large debt. They have tremendous revenues. So why wouldn't you invest in companies such as NVIDIA? And the idea is that it's not sustainable long term. That's obviously true. And one of the most important things that's going to happen today is NVIDIA is going to announce its numbers, and its numbers are going to be, as Sasha said, very good. There's going to be a great revenue reported. The number, however, will be cautioned by some by saying, as Sasha pointed out, data centers need a lot of energy, and where they're going to get that energy. Well, that is a problem to be solved, but that's not going to affect the near-term future of the company. That may be a long-term problem in terms of 5 years. That's my thinking of long-term.
Quick question, and just wanted to jump in on this, because there was a particular stock that apparently did quite well during the pandemic and everything. I was looking at one of the companies which we're using, but I think they're private. But this other company I'm going to mention is public, and it's kind of put to what point that Milan was making, which is that sometimes companies are doing well because of what's going on in society. So apparently Zoom, you know, that popular franchise did quite well and everything like that, but it's not doing that well now because not everybody is as much on the internet as they used to be as much as they were on during the pandemic. Not that they're not on Zoom and StreamYard, but it is taking a dip because when I
Most
looked up,
people didn't know what Zoom was before the pandemic, and now
right.
everybody knows what it is.
But it seems like it's taking a dip. So I just wondered y'all's thought about that because when I looked up Zoom, because Zoom trades on the stock market, it looks like it's taking a dip because it's not as popular as it was during the height of the pandemic.
Of course
I
not.
want to talk about debt for a minute. Going into debt to buy an appreciating asset makes a lot of sense. Going into debt to buy a depreciating asset is a stupid way to go. And most automobiles out there have been bought that way. People use borrowed money to buy a depreciating asset, which is an automobile. But people using debt to buy, let's say I'm a retired dentist, a dental practice, a dentist couldn't possibly get into business without using borrowed money to either establish a practice or to buy an existing practice. So there's good use of that and bad use of that. Now,
what to talk about in terms of what Mark's saying is that if you bought Zoom in 2019 and sold in 2021, you would have made a tremendous amount of money. But if you held on to it, you would have lost money. It's actually trading about what it was trading at in 2019. So you wouldn't have lost money. You just wouldn't have made any. And so the idea of these companies that are get very popular and then go away, Zoom hasn't gone away, so you wouldn't have lost money. You just wouldn't have made money. But the idea here is to think about what's going to, nobody could have predicted the pandemic. Nobody could have predicted when it was going to end. And, so these are the types of things that you're beyond your control. But there are things that you can, through analysis and discipline, pay attention to and make good bets, 68% kind of bets. So you're talking about artificial intelligence, companies that have shown a proven track record of revenue, aren't encumbered by debt, and their potential for future revenues are great. When NVIDIA announces its numbers, it's going to affect the entire market, and it may last to the end of the year. Now, will it last for 5 years? No. Will it last for the end of the year? Probably. That's almost certain it will. Now, if the market reacts with a positive reaction, then this is going to affect the broader AI segment quite a bit. So if you're invested in other AI, and old companies such as AMD and Intel have done pivots, so they're now invested into artificial intelligence. So these companies will be buoyed if NVIDIA's numbers are good. But the broader market will react again because people react with positive vibes to good news. And so when the market starts to lift, then people are going to get confidence in the market right now. And the market's confidence has been shaken in the general public's eyes. But this is also was very predictable. As I told you guys, I increased my cash position by a modest amount in August because I was concerned. September, October, November, these are types of, people tend to shed some of their holdings during these months towards the end of the year. But December is a different story. People are buying and selling based on tax reasons. And these are the money managers who want to report good numbers at the end of a quarter. And so January to me is going to be another good sign. If it's a positive month, then that bodes well for the near-term future, for the foreseeable future. And that's all I really care about, because I'm going to be agile enough to adapt to things that happen. And if the things change, then I'm going to change my positions. If artificial intelligence suddenly dries up, I can't see that happening. And these companies stop making money, I can't see that happening. But if there is some sign that they have stopped generating these enormous amounts of revenue, adjust my position accordingly. This seems to make a lot of sense to me, and it's been very rewarding to have this type of approach.
What you're talking about, James, requires daily attention, constant attention, picking individual stocks. Now,
incorrect.
What David Svensson is talking about requires hardly any attention at all. We can do it on a part-time basis. I'm retired. But when I was in practice, I had 15 minutes set aside, 15 minutes. When the market opens, I wasn't seeing any patients. I was going to take 15 minutes to do whatever I was going to do. And it hardly ever required 15 minutes. and then I could go away and go back to practicing dentistry. But what you're talking about requires constant attention.
That's not correct. That's absolutely incorrect. I don't spend a lot of time studying these things because these things have an order of magnitude to them that affect the entire economy, and it's obvious when things change. To me, it's obvious. So I don't have to spend every hour of every day looking at my numbers. I probably spend 15 minutes a day doing that. So what we're talking about now is a different methodology. But we're not talking about an enormous amount of time or enormous amount of energy. What we are talking about is a different methodology. That's all.
Are you talking about studying individual stocks based on their price earnings ratios and the management and that kind of stuff?
No. The price tells everything. You don't need to know anything about management, about their profitability or margins, or doesn't matter, because price accounts for everything. Everything is in price of the stock.
You know what?
PE ratios is old-time, old-school investing. We're talking modern investing, which is looking at revenues. And so the companies that are poised for future revenues is the companies that I want to invest in. And so it's all about the numbers. And I don't have to track the numbers on a daily basis. Once a quarter, they're reported. But, there's announcements and there's rumors and there's thoughts that periodically percolate, but they always come to my attention. I don't have to go seek them out. They're reported in the headlines in the business section of the paper.
You know what you're talking about? Both of you, Sasha, are talking about price. The only thing that matters. Management matters a lot. And you can ask Gemini about management, because managers will do well regardless of where they go. If they go to make buggy whips, they will do well because they know how to succeed. They're successful managers. So you can ask Gemini about the track record of any management group of any corporation.
But
so again, you're talking 15 minutes most.
How relevant this information is to me? You're talking about it's free? No, it's not free. It would take my time go to Gemini and look at this absolutely useless information, which in fact could be quite harmful for you if you will follow. So your example today is the best example. Instead of making some money, you didn't, because of the Gemini. So how useful is this information? It's
No, if he makes money 68% of the time, I'm all for it. But the idea is
about 68%, Jim. What are you talking? What nonsense is that? Is
is
a day? Is it
68% probability of successful trading?
Oh, please.
That's what he's talking about, Sasha.
No, I don't believe even for 1 cent this information. It's a harmful information. You have to be self-confident about what you're doing. And Gemini just put it in the garbage, please.
Oh, hold it, Sasha. What you see here is SPY. It's green. It's going up. Not a good time to be writing cover calls on it.
It's going up? Let me check.
Look at this. This green over here is
500 is up about
SPY, and it's going up. When security goes up, it's better to hold it than it is to write covered calls on it. So,
depends on covered call. But if you would sell 665 covered call in the beginning, you would make money. You could even close your position now and still make money. I don't know what you're talking about. I really don't.
Well, SPY is rising. When the security is rising, you're better off holding that.
Depends. If you sold 665 calls expiring at the end of the day, you would make money. And even now, if you would close your position as we speak, which is 662.54, and you sold 665 calls, you would already close position by now and make your money. What's the problem with that?
So this is what you're talking about in modern investing. The premiums matter to Sasha.
Yeah, right, yeah.
And so when you factor in the premiums, that's really what you're looking at. Was it a successful trading day or not?
Okay, I'll tell you that today I did a lot of trades in and out. On NVIDIA, I made a few trades. I made $961. I made $90 on NVIDIA. I closed the short position on puts. What is that? I sold some calls that I had, generating $97. 37 on Palantir, $92 on SPY. By the way, I bought 100 shares and then sold it at a little profit. AMD, I traded once or twice a day, making a little bit of money. So this is really what I want to see. I'm rewarding myself for being confident, for following the markets. So I'm going in and out, depends on the market condition and particular stock, and making money along the way. And right now, actually, my biggest position is I have 500 shares of JP Morgan, and I sold covered calls for this position. The calls were February 2305. So I was paid for each call $15. So we are talking about $7,500 for what? For holding JP Morgan. JP Morgan will go to much higher levels than there is today. That's my opinion.
What you said today that you did today, Sasha, what you did today,
Yeah.
It took a lot of time. You couldn't have done that in a few minutes. You did this and this and this and this.
I spent maybe half an hour for all that because I had a show in the morning from 10 to 11. Then I went out to buy some stuff. Then I'm going out right now as soon as we finish. And so I spent half an hour on
picking stocks, according to Svensson, your chances of beating his recommendation of an asset allocation of, let's say, 50-50, your chances of doing better than that are close to zero. Now, some people have done better than that. Warren Buffett has done better than that, and so have a number of other people, and you too may have done that. But, individual investors cannot outperform David Svensson's recommendation.
But do I care about all other investors and Svensson himself or Warren Buffett for that matter? No, I care only about my performance.
No, that's true. As you should. But we should look at a system that applies to everybody, a system that works, not a Sasha Star who is a star. Most people aren't.
That's right. That's why I'm trading only for Sasha Star, for no one else. And this is by far the most important to me, by far, really by far.
Well, the nuts and bolts of what we're talking about today is that if you believe in yourself and you have discipline, then by all means do this. And there's going to be a lot of people who believe in themselves and don't know what they're doing.
Yes.
And that's going to make markets.
Most people lose money in the market. Call them investors.
And that's the fundamental reason why. They don't know what they're doing. They may be disciplined. They may think highly of themselves, but really they're making bad bets here and bad bets there. When you're sitting at a poker table, you can usually, after half a dozen hands, know who doesn't know what they're doing. And if you can't tell who doesn't know what they're doing, you might be at the wrong table.
Wonderful, Jim, 100%. Okay, guys, thank you so much for today's program. We'll continue next Wednesday, same place, same time. Thank you so much, everybody.
Thank you.
Bye-bye.
Bye-bye.